Ayan, okay guys. Welcome back. So, as a continuation ng ating uh, discussion on consolidated financial statements after the acquisition date. Yan. So, to illustrate our discussion, let's take up illustration 3-1, which is a uh, 80% owned subsidiary under the cost model partial goodwill approach. So, the consolidation process for a partially owned subsidiary is the same as for a wholly owned subsidiary, except that the claims of the non-controlling interest must be included. So, assume that on January 1, 2014, Perfect Company acquires 80% of the common stock of uh, Sun Company for 310,000. At that date, the fair value of the 20% non-controlling interest is estimated to be 77,500. So, we have the fair value of our non-controlling interest. Okay? So, uh, on the following assets and liabilities of Sun Company had book values that were different from their respective market values. So, ito yung book value versus ating fair value. So, all other assets and liabilities had book values approximately equal to their respective fair values. So, you will see this illustration in our book for your reference. And also, before we continue, I would like to give credit to Mr. Antonio Dayag, sir. Thank you for this very wonderful presentation that we are using currently in our class. Yeah, thank you, sir. So let's continue. On January 1, 2014, the equipment and buildings had a remaining life of 8 and 4 years respectively. Inventory is sold in 2014 and FIFO inventory or first in, first out inventory costing is used. Goodwill, if any, is reduced by 3,125 for impairment during 2014 based on the fair value basis or full goodwill, meaning the management has determined that the goodwill arising in the acquisition of Sun Company relates proportionately to the controlling and non-controlling interest, as does the impairment. So, trial balances for the companies for the year ended December 31, 2014 are as follows. Ayan, so ito yung kanilang trial balance. Okay? Ayan. So, please refer to your book to have a clearer view of our illustration. Yan. So, from the trial balances presented above, the following summary of 2014 results of operation are as follows. So, sales, okay, then cost of sales, gross profit, depreciation, net income, and the dividend income. Okay, so the dividend income for the parent company, which is the Perfect Company, came from the Sun Company. Okay, so our net income per trial ay per separate books would be 164,000 for Perfect Company and 50,000 for Sun Company. Ayan, the resulting ownership situation can be viewed in the schedule of determination and allocation. Yan. So, the fair value of subsidiary, which is 80%, the consideration transferred is 310,000, is the book value of equity, which is 240,000. Then, our allocated excess is 70,000. Then, our, yan yung difference ng ating valuations. Okay, which is 60,000. Our partial goodwill would be 10,000. Okay? So, the building and equipment will be further be analyzed for consolidation purposes as follows. Okay? Ayan. Yung ating equipment at fair value is 150,000. Yung ating building would be valued at 120,000. So we have a net book value of ayan 100 bali 270,000. Then our difference in valuation for the fixed assets would be 60,000. Okay? Yeah. So, summary of depreciation and amortization adjustments as follows. Ayan, please refer. So, ito yung magiging movement ng ating depreciation and amortization. So, the goodwill impairment loss of 3,125 based on 100% fair value would be allocated to the controlling interest and the non-controlling interest based on the percentage of total goodwill each equity interest received. Okay? Ayan. So, for purpose of allocating the goodwill impairment loss, for the goodwill is computed as follows. Ayan. So, yung fair value ng ating subsidiary would be 387,500 less yung book value ng ating shareholders equity of 300,000. Our allocated excess is 87,500 less the valuation differences. So our full goodwill is 12,500. So in this case, the goodwill was proportional to the controlling interest of 80% and non-controlling interest of 20%. Okay? Ayan. So, yung ating goodwill for parent would be 10,000 and 2,500 for our non-controlling interest. The goodwill impairment loss would be allocated as follows. Okay? 20% kay non-controlling interest and 80% for our controlling interest. So, yung ating total impairment would be 3,125. Okay? So, first year after acquisition, parent company cost model entry. Siyempre, yung cost model entry natin, we only record yung sa acquisition, which is the cost, and our dividend received. Yan. So, our consolidation work paper for year of acquisition. Ayan. Yung ating entry would be to debit 200,000 and credit 100. I mean, to 100,000 for retained earnings. That is to eliminate our subsidiary equity account. Yan. Then, credit investment account for the parent and the non-controlling interest. Then, also, the allocated excess would be adjusted to our assets and liabilities. Okay? Ayan. And also, our impairment loss and depreciation amortization excuse me, this would be at the end of, the consolidation period. Ayan. So it should be observed that the goodwill computed above was proportional to the controlling interest of 80% and 20% non-controlling interest. Okay? Yan. So therefore, the goodwill impairment loss of 3125, ayan, will be allocated as follows. So yung ating entry to eliminate intercompany dividends, yan. Then another entry to establish non-controlling interest dun sa ating consolidated FS. Ayan. So, ayan. Please refer to our book for a clearer view. Ayan yung ating worksheet. Then, we have we have recorded our elimination entries. Then, our consolidated FS would have a total net income of 176,500. Okay. Yan. Less the uh, portion of our non-controlling interest. And our total asset would be 2,020,500, and equity and liabilities of the same amount. Ayan. So for the consolidated net income, the non-controlling interest in consolidated net income, which can be verified can also be computed as follows. So ito yung net income ng parent company natin, 140,000, and our subsidiary company of 50,000. Then less the controlling interest of non-controlling interest in net income, and then less the amortization and impairment, and we have the controlling interest net income. Then add the non-controlling interest net income to come up with the consolidated net income of 176,500. Okay? Right? Yan. Yan. So, since the non-controlling interest share of goodwill is not recognized, no adjustment is required for the impairment loss. Yan. The goodwill recognized on consolidation purely relates to the parent share. So, non-controlling interest is measured as a proportion of identifiable assets, and goodwill attributable to non-controlling interest share is not recognized. Alternatively, NCI on December 31 may also be computed as follows. So, you have non-controlling interest, partial goodwill of 75,000, add the non-controlling interest of in net income of 7,800, and less the dividends of 6,000 to come up with our non-controlling interest as of December 31 of 76,800. So, on the second year, ayan, i-compute din natin yung ating depreciation. Okay. Ayan, we will have the same entries and treatment. Okay. Ayan. Okay. So, I think I will end on that for our discussion. Thank you, and have a good day.